Wall Street sits and waits. We have the key inflation data coming out next week, and we're wondering what the Federal Reserve is going to do at its next meeting. Welcome, everyone, to Buy, Hold, Sell. I am your trader, Todd Schoenberger, and I am joined by my friend and co-host, Tobin Smith, out in sunny and hot, scorching hot.
Not that hot,
Arizona.
Todd.
It's always hot there. It's a dry heat, though.
Look, at 105 is the new 95, okay?
There you go. Well, we have a very special guest with us. He's returning to the show. He is a longtime favorite of Buy, Hold, Sells. We have Jeffrey Hirsch from the Stock Traders Almanac. Jeff, thanks for joining the program.
Great to be with you guys again.
Yeah,
I know. Well,
he got started a little early. Okay, I'm just saying.
Well, I got to tell you, it's the first weekend of week one of the NFL. I'm wearing my Ravens jersey because we already know after last night's game, the Lions are playing the Ravens in the Super Bowl. But we'll talk about that later on in the show. And but right now, Jeff, I got to turn to you. You've been spot on with this stock market. You talked about how August was going to be a troubling month, and you then came out and said September is the worst performing month in a pre-election year. And I think you're right, but does it hold for the rest of the month?
It's looking like it's working out that way. I mean, seasonals and the four-year cycle have been tracking incredibly close to the last 3 years. We've discussed it together a few times. And you come into this rough seasonal patch. September, we've already had our August correction. I think we can have another one, maybe even break those August lows a little bit. But there's a lot of other things going on. So you've got the seasonal weakness. You've got that October 31st deadline for mutual funds that where they have to reconcile their accounting with the previous year's 10 months, the full year, and this year's 10 months, and get all that stuff done. So, and then there's the end of Q3 where you get that window dressing. So everyone's setting up for the Q4. And we had our sweet spot of the 4-year cycle, those 3 quarters that we discussed, midterm Q4 to the first 2 of pre-election year. And we're looking, like we're going to have some selling here. I'm not going to be surprised. I'm actually concerned about a September surprise in the financial sector. I'd like to hear your guys' take on that too, especially coming from Toby. I know you got your ear to the ground and a lot of that stuff, but with the 10-year toying with the high and the Fed, not knowing what the heck's going on really, at least anymore, we're concerned that we could get some downgrades or something to shock the system here during, then we have October phobia. So I'm calling it September October phobia now. Because
you've expanded. Just as a side note, I was looking back at not only does the September and weakness, go back 10 years, 20 years, it goes back 50, 100,
70, yeah.
Right. And in the old days, when I was born, not you, the agrarian society that we had, the banks would lend money, to plant the crops, and then they'd harvest money. And then the reason why the market was down in September is because they were paying off their loans.
And
the liquidity went
back
down.
Back in those old days, when we do the seasonal studies from before World War II, it's a buy in May, not a sell in May, but it still tops out in September during harvest season. So, and I talk about that the old agrarian society driving things, but it's definitely when the notes were due. Go on.
Well, and then, the other thing, recently obviously has always been, look at August, everybody's going to the Hamptons, the Jersey Shore, your backyard down there. And, there's just less volume. There's less, because there's less volume, there's just less aggregate money. What's different this time, Jeff, I think is, but in any of those other times, we didn't have 7, 8, $10 trillion of cash injected into the system, and I assumed that we wouldn't get as much of the September phenomenon as we're going to, but
the old Odd Couple episode when you assume, sir.
Yeah. Well, what I find intriguing is that remember, we have this is an emotional thing, the stock market, right? And so sentiment had gotten so bad and cash had built up so much that we did have this, rush from April and things were oversold, and then we got AI mania and yada 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 yada. Now, it just feels like, you know, the old saying, we're over our skis. That the valuations are over the skis. That, you know, the market itself is overbought, and it's just. I wrote to my newsletter subscribers this week. If you're in a bull market, which we are in a new bull market, then you want to have pullbacks. What you don't want is the market to go up 25% in 3 weeks.
It's exactly what I'm talking about with my subscribers. I mean, I'm saying this weakness is going to be temporary. We've got some of these other factors other than the seasonals. Inflation, we think, is done cooling. I mean, we have a projection chart. I don't know if you guys, if I saw it, I think I put it out on the blog too, where, you know, unless the CPI goes up less than 0.2% month over month, the year over year is going to increase. This 2% thing is impossible to reach. You know, and the 10-year, the yields are going up there. People have better places to put their money, but that's all a nice little reset right at that, you know, end of pre-election year, the Q4 period, where it happens every year. I mean, we have a page in the Almanac, Q4 market magic. It's even more pronounced in this third year of the cycle because of the behavior, the repetitive behavior of institutions, how they move their money because of the calendar.
Yeah.
So go ahead, Toby.
Well, I'm just, you know, again, it's also the time frame you're talking about. In other words, many times people don't quite understand that 75%-ish of the trading yesterday was algorithmic trading, was computer trading, right? And because of that, if you look at, you know, the Renaissance Fund with $25 billion, who's making 8,000 trades a day, in 2-minute, you know, formats, blah, 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 scalping a penny, scalping, you know, 3%, 4%. When the institutions are sort of sitting on their hands, then those guys control the short-term part of the market, right? Number one. And then number two, look at, you know, we have this rule that if something, you know, goes straight up, that we start to sell into that, because nothing goes straight up except something where there's short covering and, you know, and other type of mechanical issues. And look at NVIDIA. I mean, if NVIDIA has now become the poster child, Apple used to be the poster child, and now NVIDIA is healthily pulling back. You really can't sell for 29 times sales, no matter how great AI is going to be. So there is this thing called financial gravity, guys. And financial gravity is run by the difference between the greed of the bulls, the fear of the bears, and the short covering of the shorts. And that hit all at the same time, and you get anti-gravity. Everything goes up, right? But sooner or later, financial gravity comes back hold, and people who run money like me are saying, gee, let me see, the average market return, Jeff knows better than I do, but what is it, 9% since like 1989?
7, 8, 9, depending upon the index.
Yeah, the index. If you make 80%, like we did on our, you know, chips and semiconductors and so on and so forth, in 3 months, and you don't take profits on that, then they should take the money away from you.
There's a song, Spinning Wheel.
Yeah, right.
Goes up.
So people like me are saying, listen, you know, I would be not a fiduciary. I would be against my fiduciary duty. Say, oh, yeah, no, we're going to just stay long, all that stuff. You know, 80, 90% profit. Oh, everybody makes that. No, you don't. And so that's what people are doing, is that people who actually run money, you know, for other people and manage money actively, not passively, are simply just cashing in, building cash, letting the normal Jeffrey Hirsch September, you know, come back.
I mean, well, all seriousness and all due respect, that's exactly what creates this September weakness phenomenon. It is because of people doing that, and institutions like you're talking about doing that year in, year out on a regular basis. It's the quarterly behaviors of institutional fund managers.
So with that said, Jeff, then it sounds like all the talk about potential hikes in September, but also one more before the end of the year, and potentially maybe even into 2024, because you said we're never going to hit that 2% target. But
I don't think
Jerome Powell is.
I think it's like,
no, we are going to hit it.
When you got somebody that's always late to an appointment, you tell them that you give them a half. We'll meet at noon when you really want them to be there at 1. So he's saying like we're shooting for 2, but we'll be happy with 3 when they get there.
Well,
hold on, Toby, but think about the repercussions of that. I mean, because every meeting they're talking about 2%, and he comes out and he's stomping his foot up there and he's saying, "No, we're going for 2%."
So they'll find the metric. They'll find the metric that measures 2%, even though it won't be what the rest of us feels out in the real world. The CPI will be 3.3. The PCE deflator will go down to 2. PPI might drop down there as well. But
the CPI headline's got to be super high only because gas has gone up with oil going higher. But the core rate, should look pretty healthy. Go ahead, Toby.
Bianco and I was on last week, and by the way, Chad, it was the first time I ever saw him laugh. On CNBC for 25 years, he's never cracked a smile. And
he's good. Jim's good.
He's great, and so
great guy.
We both agreed that truly the Fed missed the transitory dealio, and they got 115 economists there. Nobody built a model about how sort of these unique situations. Similarly, if all of our disinflation over the last 20 years, a significant amount of it has come because we offshored all our manufacturing to China, and those we had consistently could not get over 2% inflation for all those years. Now that we're essentially reshoring, how in freaking possible is it that we should use a 2% inflation rate when we essentially have imported another 1% inflation rate by reshoring? Don't you change the model when everything else changes?
They should. I mean, they change it when it suits them to, maybe make it that two negative quarters of GDP doesn't equal a recession anymore, just because they need to claim a recession some other time.
Yeah.
I mean, they've been manipulating these numbers for years. So, GDP up at 5 point whatever percent. It's 5.6 last estimate from the Atlanta Fed. GDP now there. That's pretty inflationary. That's a little warm. You think they would remodel things. There's an old quote. I think it was either Eisenhower or Reagan. Like, I wish I had a one-handed economist so that he couldn't say on the other hand.
Yeah, that was Reagan. That was Reagan.
It was Reagan, right?
Yeah.
And then
it will be interesting. I think what's so confusing, and I wrote about a lot of this week, is what's so confusing to everybody. And first off, is people who don't think that we're in a confusing time, then they're just full of smoke. But I could count 20 contradictory positives and 20 contradictory negatives, all happening simultaneously, and yet we still have all that huge cash sloshing. No one talks about the Fed's taking out $95 billion a month. Where was that?
and just the government spending alone.
Yeah.
I mean, even the Federal Reserve, but the federal government just spending a ton of money on everything.
Well, contextually, as I told Todd, or said yesterday, when I was slinging 13, 14% 10-year bond funds in 1983 to pensions, I would tell these guys, dude, this is even you can't screw this up. Just buy the freaking 30-year bond here. It's going to be worth 5 times what it was. Blah blah blah. Right? But at that time, we only had a $228 billion deficit, or actually deficit. We had $228 billion of debt. Today, we've got going to $35 trillion by the end of the first quarter next year, and now we're pussyfooting around with like the little stuff. We don't have that flexibility that we had years ago, and so all that being equal, the stock market is still a derivative of the future earnings that it is discounting. There's great trends happening, and we're making stupid money in stocks. But on a macro basis, to try to really say, "Oh yeah, I got a good handle on this."
There you go. Well, Jeff, we had you on the beginning of the year, and you were very bullish, very optimistic for the coming year, and you were spot on. I mean, it was great and great forecast. How accurate has this year been, though, to what the Stock Traders Almanac had maybe predicted?
I mean, it's super accurate. It's scary accurate. Making me wonder if this can go on for many years. But actually, even better than expected. I mean, I don't know if you remember. I think I said it with you guys on the air that if there was one thing I was most concerned about was not being bullish enough, and we
Yes.
exceeded. Yeah, I mean, I said it a few places,
Mhm.
but our best.
We had it first. We had it first here at Buy Hold Sell when you said it.
Calm down, Todd.
Probably,
Calm down,
yeah.
Todd. Just take a deep breath, okay, Todd?
We had the exclusive.
It was you.
I just want to point that out.
We had our best case, outlook at 15 to 20%. We surpassed that. We gave some back a bit. I mean, what the NDX was up 45% at the highs, if memory serves.
Yeah.
Right.
But that's very, typical pre-election year behavior. I mean, the move from the midterm low to the pre-election year high for NASDAQ is 68.2%. For the Dow, it's 48%. So, yeah, it's kind of right in the Almanac wheelhouse ballpark.
It's interesting because all the guests, hold on, Toby. All the guests that we've had on Buy, Hold, Sell this year, I would say, I mean, from Dan Ives, Liz Ann Saunders, Gina Martin Adams, Sam Stovall, our friend Sam Stovall. I mean, everybody has been bullish. I mean, Katie Stockton's probably been the most bearish out of the entire group that has been on this show.
That's because she's a pure technician, and
you're right.
Well, that's the nerve-wracking part of it, though, because then that makes you think, hold on now, as a technician, what is she seeing that everybody else isn't? And so far, over the last 5 weeks, I mean, she has been accurate.
Well,
yeah, she's great.
Yeah.
I mean, technicals are important. I just use them in conjunction with fundamentals, seasonals, monetary policy, and sentiment and what's going on in the world.
Yeah, it's just we just have still lags from the pandemic. We have lags from the invasion. We have lags from the not passing a freaking budget. There's just significant issues that all are colliding, at the same time, like it's a WWE match with all the the rest.
Well, I mean, it's like the rolling recession we had, like the rolling bear market bottom we had. We've got lots of cross currents. We've got inflation up, GDP up, the labor market still, strong. I know it's maybe weakening a little bit or coming back to normal. There's just the consumers, having a little bit of an issue here, but still strong. You got emerging markets are having some trouble. China's having some trouble, but the US is great. Small stocks are struggling, but big caps and tech are great. I mean, there's a lot of, yin and yang going on.
Yeah, you're right.
Jeff,
go ahead, Toby, close it out.
I've been talking a lot about the non-politically correct aspect of what in the United States is, which is if you do the math, the top 20% of households by income provide about 78% of the discretionary spending. So it really doesn't, count. If you're looking at the whole GDP, it's the core GDP where that discretionary spending, that's at the margin, how our GDP grows. And then secondarily, we have 63 counties in the United States that account for 74% of all the GDP. So, there's a lot of parts of the country that can be weak, but on a gross GDP basis, it doesn't really matter. What matters is that the unemployment rate in our 63 super counties is about 2.5%. And so, that juggernaut, Germany doesn't have that. The UK does not have that. And because they're a manufacturing economies and we're a service economy, we are the buoyant place, which I do believe, because money comes from everywhere. If I'm running a German pension fund, I'm not investing in the German money right now. I am in the American, because we don't have a natural gas problem. We have a surplus. We don't have it's.
And you wonder why the dollar's so strong.
Right. Well, there you go. Well, now that the entertainment portion of the show is over, let's cut it to break on this one. But coming up after the break, we're going to ask Jeff what the Stock Traders Almanac tells us about the fourth quarter in a pre-election year. Wondering what he's going to say to us, because we want to know if we should stay bullish or if we should maybe think about being bearish. But we will be answering that, plus Super Bowl predictions, when we get back after the break. Please stay with us.
Buy, Hold, Sell, brought to you by Crosscheck Management. There's something special about Friday night college football games.
When you have a Friday night college game, everybody's watching. Prime time, national audience from College Park. Friday night in the shell, nothing better.
What does it mean to be a leader?
It's taking my first solo flight.
At the University of North Dakota, we lead our own way.
Stock market ended with a snooze, actually. We actually ended a bit flatline, a little bit up, but for the most part, not a lot of activity because everybody's waiting for the key inflation data to come out next week, thinking that's going to actually move the needle for the Fed for their September meeting. But with all of that said, we do have with us a very special guest, Jeffrey Hirsch. He is the editor of the Stock Traders Almanac. And Jeff, when we left it in the last break, we teased it with wondering how the fourth quarter looks going into the election year. Now, our friend Sam Stovall has been all over the media. He's been giving speeches and he's been talking about a Santa Claus rally. Is that what the Stock Traders Almanac is telling us as well?
Well, the Santa Claus rally was invented by the Stock Traders Almanac. And
I was going to say, I remember that.
We discussed this last year, and if Sam is talking about a Santa Claus rally, is he talking about the real Santa Claus rally or any year-end rally?
Well, he's talking about the guy. I think what he's saying is that we're going to see a Santa Claus rally from October 1st through Halloween, Thanksgiving, and well past Christmas. He's very optimistic.
That's not a Santa Claus rally. The Santa Claus rally is the last 5 days of the year, the first through the new year. That's called the fourth quarter rally.
Yeah.
But if everyone's
very premature,
rally,
so maybe.
that's great.
All right.
Sam's reading the Almanac. Sam and I are friends. He and I agree on these seasonal patterns, these 4-year cycle patterns. And not only is the fourth quarter expected to be strong this year, it is generally for pre-election years. But the interesting thing is that the highs for pre-election years tend to occur in December, and an incredible cluster on the last trading day of the year. So I'm even expecting new highs either on or around, maybe shortly thereafter year end, because we see this. I'm looking at one of my charts that I put out there on the screen, and the last half of December, which is when you get the small cap rallies or the old January effect, it goes straight up.
Back up. I have to make sure I understand this. What you're suggesting is that we will see higher highs for the markets in 2023, potentially in the last trading day of the year.
Potentially, yes. Yes.
Incredible.
It shows up on my stats. I mean, there's a page in the Almanac. I think it's right here, even in the 23, 50% moves, and you can see a lot of December 31s on there. I mean, I don't want to take the time to look at the page. Oh, here it is, page 30.
Page 30 of the Stock Traders Almanac. So if everybody at home has it,
December 31, December 27, December 13. I mean, a lot of 30s and 31s and a bunch of other days in December are the high for the pre-election year.
Hey, Hirsch, talk about talking your book. You are actually talking your book.
There you go.
I mean,
so, do you agree with him?
Yeah. Well, what I find is interesting always is that, you get into the last week before that you can take a loss on a stock and write it off against your gains. So the small cap ones, always sell off if particularly if there'd been a lot of profits made. So they pick the losers, and so that's just market mechanics. But then when I used to run a mutual fund, you get a little jiggy about December 5th if you're behind your mark. And shockingly, Jeff, just shockingly, I would buy things purely because they had the most momentum, and I could end the year strong. And I didn't really care what the hell I'm a fundamental guy, but dude, if freaking Nvidia was going up at 15% a week, and I was behind my bogey,
you have to put it in your portfolio so that everyone who sees your end of your statement sees that, hey, he owns the good stock. Yeah,
exactly. And so those type of mechanics, that's why I love doing this show, because they don't talk about it, on CNBC and other ones. They pretend like blah 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 blah.
All
No, are you
earnings
kidding me?
and valuations and
Yeah, it's all about valuation, blah blah.
there's no emotion in the stock market whatsoever.
Yeah, exactly.
Yeah, right. Well, it's obvious that Buy, Hold, Sell is the best financial show out there. So we already know that. But Jeff, go. But with that, okay, now let's talk about a little bit. Now you're going to be on the show. We'll have you on the show multiple times. We have the new show coming out, obviously, and we'll get into that later on in future episodes. But I have to ask you, what about the election year, though? So should investors be thinking, okay, let's buy this, let's ride it all the way up to the end of the year, and then get out, or should they just continue to hold into that election year?
Yeah. Next year is probably going to be bullish as well. Not as bullish as this year. Speaking of my book, again, we've already sent the 2024 Stock Traders Almanac to press. It's being printed, should be off mid-October in the warehouse. You guys will definitely get a personalized copy. Perhaps
hey, I like that.
A table in a fancy restaurant somewhere.
There you
go. Maybe we'll wear sport coats or something like that. But one of the key points, and I do my outlook for 24 around June when we send it off for proofing and stuff. So you got to look 18 months out, which is it takes a set and a little bit of experience and learning from Yale, my father, and just doing it for a while. But one of the things that we talk about is, not just the power of the 4-year cycle, but the power of a sitting president running for re-election. Politics aside, whatever you think, you've got a person who runs the greatest economy in the free world or in the world. He's got the power of the bully pulpit, and his administration is trying to keep himself or his party. It's even more so when you got somebody running for a second term in power, and they're going to do everything they can to make the country happy and the citizens happy and people happy. And that power is quite prevalent in the chart. And sitting presidents, maybe up towards 12%. I'm looking at already. I've thrown the number around about an 8 to 12% gain for 2024 from the close. And
wow,
this is the close of 23.
So let's make a clip out of that, Schoenberger.
That's a Buy, Hold, Sell exclusive. Wow, that's incredible.
Because I couldn't imagine having to make that prediction in June for next year, 2023 for 2024.
Admittedly, I've homed in on those numbers a little bit since June, as I've been talking about and previewing the book and giving my subscribers and other people, hints of what we're talking about for next year. And this gets into my super boom forecast, which we've talked about, which I made back in 2010 at around Dow 10,000 for 38,820, which is another Yale discovery of the 500% moves. And we're already ahead of schedule there. And what we're going to want to continue to study and look at is what happens after that. 2025 post-election year, second term president. We're going to have a lot of we're still anticipating all the impacts of the war and COVID, like you mentioned before, and all the money coming in there. There's going to be, a comeuppance on that on the other side, in addition to the long-term secular cycles. And we may end up going back into something akin to what we had in the 70s and 80s, where more of a sideways stock pickers market, which would be great for you, Toby, and your fundamental stock picking and the way I love small caps. And I'm a fundamental stock picker as well. We also pick them at that time of the year. And seasonals work great during that time frame as well. So that's just looking a little further out. But
yeah. Hey, Jeff, quick question for you. So you said in June, you're looking at the rolling 18-month period. So you're trying to predict, you have to have that vision, that you're trying to really forecast some decent numbers. How do you do that in an election year, though? Because you really are going to press before the actual vote actually is taking place. I mean, what if Biden isn't reelected?
That won't happen until 2024 November.
I'm thinking of next year, though.
I'm getting there. So you will start to see that in the beginning parts of the year. If it's likely that Biden doesn't get reelected or the incumbent's not reelected, you'll see weakness early in the year, the first 5 months. but you end up getting something that I've called the sort of ding dong, the witch is dead effect at the end of the year. So you've got the power of a sitting president driving things bullishly. But if the country's not happy, whether it's economic, it's always the economy stupid, or something else happens health-wise, or, scandal, or, overseas, or, geopolitical, and the country becomes unhappy, the market will reflect that. You'll see that in the first 5 months of the year. That's also part of the election year perspectives, that page that it says in the Almanac. But once that new president or that existing president is ousted, the market rallies in celebration that we got rid of the bad.
Let's switch topics right now, and because we're going to close out the show. Let's talk about the NFL season. You got week 1 coming up. When this show airs, it's going to air on Sunday morning before all the games start. We just saw the first game. The Lions beat the Chiefs. It's obvious that the Detroit Lions are going to the Super Bowl. I mean, that's how I look at it. But what do you guys think? Now, you guys
Todd,
know where my allegiance stands.
Todd,
you already know. I already know the Baltimore Ravens are going to win the Super Bowl. It will be our third Lombardi
You've
Trophy.
been saying that for 20 years. Look, it was not the Kansas City Chiefs. It was the Kansas City Chiefs without Kelsey, the greatest tight end of all time.
Yeah.
And without Jones,
He's not Mark Andrews. Mark Andrews for the Ravens is the best tight end of all time.
You guys, you have the best place kicker. Okay, I'll give you that. Okay, but
there you go.
So as a lifelong Giants fan, New York Giants fan, I don't move teams with when I change locations. Yankees, Giants, Rangers.
Of course, we're East
Knicks.
Coast. Yeah.
I was at the Knicks games when there were 6 people there, including me. back in the old days, in the late 80s. But I'm curious to see if the Giants can actually, the G-men can be impressive, because my ADD will kick in if they're not good, and I'll get bored, and I'll start watching golf or rugby, or the Rugby World Cup. So they got to make it exciting, and there's too many damn commercials for me.
Well, you're not making a prediction. You're just being sentimental. The Giants have about as much chance of winning the Super Bowl as I do, and buying the house next door to me over here. Okay, but
so I'll be watching the Ryder Cup then, huh?
Yeah. But
Toby, give a prediction. It can't be the Colorado Buffaloes either.
No. I believe that Kelsey and Jones are coming back. I believe that we're going to have a reprise of last year, because the AFC is like the Super Bowl already of football teams, and nothing else really counts, Todd. That's what I'm telling you. And Hirsch can nibble all he wants about his Giants, but look at Burrow's just got a $50 million a year contract. All these quarterbacks are making $50 million a year, and there's a reason for that, because they win.
What about the poor running backs?
The running backs are just there to block the freaking linebackers who get into running backs. Don't do squat.
Brain injuries and no money.
You're right.
Listen, it doesn't matter. All I know is that I'm always going to say the Ravens, but it's great to be a Baltimore fan. We got the Orioles are going to win the World Series, and you got the Ravens winning the Super Bowl. Where else would you rather be? That's all I'm going to say. We'll close out the show on that.
You are a stop clock analyst.
Not a year for New York sports.
Yeah.
There you go. So listen, we're going to leave it there on this show. And I want to thank Jeff Hirsch. He is the editor of the Stock Traders Almanac. Jeffrey, thank you so much for joining us today. Always love having you on the show. I know we're going to have you back, and we'll definitely get you in studio when we're at the NASDAQ, so it's going to be awesome. So on behalf of Jeffrey Hirsch and Tobin Smith, I am Todd Schoenberger. Thank you once again for joining us on Buy, Hold, Sell. We'll catch you next time. Take care.
Buy, Hold, Sell, brought to you by Crosscheck Management.